Greetings, my beloved clients and friends. There's been a lot of news over this last weekend about wars and rumors of wars, and U.S. bombed Iran. And, people might wonder, should I be worried about the potential for escalation of war in the Middle East? As an investor, should I be worried? And so I want to talk about what you should be worried about and what you should not be worried about. And if war is something that you should worry about as an investor, and if not, what should you be worried about? Okay, so I've been in this business since 1991. And throughout my career, there have been a handful of big pullbacks. There have always been ups and downs. I mean, there's always good days and bad days, and good quarters and bad quarters. But I mean, the big pullbacks of greater than 30%, that's something that would really impact a retirement account. It's happened a few times, and the first one was in 2000 to 2002, the dot-com bubble, the tech bubble. Right, the markets were down, I think, over 40%, close to 50%, and the tech parts of the tech sector were down like 90%. Okay, so that's a huge pullback. And then the other one was the global financial crisis, 2008. Started in 2007, but really 2008 to the early part of 2009. Again, markets were down over 30%. A huge pullback. And it started in the real estate market, and it rolled into the stock market. And then after COVID was like just a blip. But after COVID, there was a huge run up and then a huge pullback in 22, close to 30%. There have been some other dips and blips, but those are like the handful of big ones. And none of them were created. War wasn't the thing that set them off. And they all had one thing in common, and I'll talk about what that common thing is. Okay, and prior to my career, there have been other major pullbacks. Like in 1987, they called it Black Monday, where there was this huge, I think it was 26% one-day drop. Part of it was system trading, but the other part of it was this same stimulus that created, or the same root cause, I guess, of the other ones. And then 70 to 74 was a huge market pullback on the magnitude of 30-40% plus. And then prior to that, of course, the Great Depression, like 29 to 38, which is a huge market pullback, and then endured a long time. And all these major market pullbacks, but if you chart it out over 100 plus year time, the markets are up and to the right. But there have been a handful of these big pullbacks, the kind that you should be worried about, but they're not war related. I'll tell you what is the cause, and it's Alan Greenspan coined the term in 1998, irrational exuberance. Euphoria, market euphoria is the thing that you should most be worried about, not wars. Market euphoria has always been the precursor to these major market pullbacks. And it's when everybody's invested and everybody's doing good, and there's absolutely no fear in the market because it's done so well for so long that the first movers and the second movers and the third movers and the last movers, they're all invested, and they're all invested big, and there's no money left on the sidelines. and everybody's making money in the stock market, that's the market that you should most fear. That has been the precursor to every major pullback. And so I'll give you some telltale signs of what that really looks like on the ground. That's when you should call me and say, Jonathan, should I be worried? Not a war. Okay. So in 2000, early in 2000, I think it was like February of 2000, I was working at a bank in Wells Fargo, and I was the investment advisor there. And they sent this guy to me. And he was a 63-year-old Baptist pastor. He was a couple years away from retirement. And the church had set up a retirement account for him. And he had put his retirement money into 2 mutual funds. And the 2 mutual funds, he told me what they were, and I immediately recognized, and they were super aggressive, high growth, tech.com type of mutual funds. And he said, one of them was up 50% and the other one was up 70%, he was telling me. And he goes, so what I did was I took the money out of the one that was only up 50 and I put it into the one that was up 70. And I was like shaking my head. I go, man, that's the stupidest thing you could possibly do. You're only 2 years out from retirement, and you have all your money on this one high flyer mutual fund. And for the life of me, I could not talk him out of doing anything but that. And he sat there with this air of confidence, like he had heard from the voice of God directly to put it into this one mutual fund. And I said, man, that's super risky. And he goes, yeah, but no, I feel very comfortable with my decision. And he was sitting there with his legs crossed, and this is his exact words. What's the worst that could happen? It's only up 25%. I'd be okay with that. That's what he said. And I was like, man, that is not the worst that could happen. It could be way worse than that. And he was not listening to me at all. And he was wearing shorts, and somehow when he had made his deposit, he had got like a paper cut on his finger, and his finger was bleeding, and he was sitting there sucking the blood on his finger without a care in the world. That he was extremely confident that his investment philosophy was sound and was almost divine. And man, I went home and had nightmares, because that's the last guy in America to invest. There is nobody in line behind him. Once he puts his money in, who's left, right? He's the guy that was afraid of everything, and everything's the devil. And finally, after seeing, years and years of the market going up, and he says, no, what? I'm going to do it too. He's the last guy to invest. There's no one else after him to drive the market even higher, to pay more than he did. And sure enough, about a month later, things started crumbling. And especially the types of investment he was in, I know that fund was down like 90%. And so that's the sign, that irrational exuberance, that euphoria that precedes the big market pullbacks. I'll give you another example. In 2006, prior to the global financial crisis, right, I was thumbing through Fortune magazine, and there was a picture of these Vegas showgirls in all their beautiful, revealing outfits. And I found that odd to see a picture like that in Fortune magazine. So I read the article. And what it was talking about was that these Vegas showgirls, on their breaks in their dressing room between sets, they were on the phone with their real estate agents buying real estate. And several of these girls had 2 and 3 and 4 or more properties that they owned. Okay, and I said, man, who's behind them in line to buy the next property and bid it up even higher? Nobody, man. Those girls, they should be spending their money like on Botox and purses, and instead they're spending it on real estate. They're the last ones in line. and they're buying, right? I mean, not just one, level-headed girl. I mean, just across the board. So that's the sign. I'll give you another one. This was during COVID when the government was just sending out checks, and everyone had nothing to do but shop online and watch YouTube, and a lot of those people were investing in Bitcoin and Dogecoin and super speculative stuff, and it was going up. And this client called me, and he said, my son said I should invest in AMC, the movie theater. He goes, Dad, and he explained, Dad, I mean, people are going to go back to watching movies, and this thing's going to go up. When a 17-year-old is giving you investment advice, that has not, a savvy 17-year-old, if there's such a thing. I mean, just your average run-of-the-mill 17-year-old that should be interested in girls and rims and stuff like that is investing in stocks, and he's telling his dad, pull your money, this is a for sure thing, it's gonna go up. And then he actually called me and asked me that's a sign for my advice, right? That is a sign that there's almost nobody left to invest, okay? That's the market you should be afraid of, that euphoric, irrationally exuberant market. And what happens in those markets, they're going way up, and so people get more interested, and more people get into them. And what happens is the most speculative investments are the ones that are doing the best. The companies that are losing money, the companies that are losing the most money are the ones that are up the most, right? That's a sign of a market that you should be afraid of. When everyone is giving investment advice. There's this thing in our industry called the cocktail party test. And it's when the financial advisor, the stockbroker, is the most popular guy at the cocktail party, I should start to get worried. Okay. And it's not just that when people find out that I'm invested in the stock market, they want to talk to me to hear what I have to say or to ask my advice. They specifically want to talk to me to tell me how great they're doing on their own, that they pick these stocks and they're way up, right? Like that Baptist preacher. They don't want to listen, they want to talk. And that's the sign of a top of the market, when these this is what they call it in the industry, the sharps. The dulls are making more money than the sharps, okay? Because they're way more speculative, and they don't understand the concept of risk, and they're all in, and those are the investments that are doing the best, okay? And so they want to brag about it to me at the cocktail party. That's the market you need to be afraid of, right? When I'm the least popular person at the cocktail party, because man, just the sight of me reminds them of how much money they lost in the stock market. That's a better time to invest. Okay, so if you say, Jonathan, should I be worried? You should be worried when that's the case, and that's not the case right now. In high school in physics, they taught me about potential energy and kinetic energy. And the example I said is, like, if there's a book on top of the bookshelf and it's like hanging over the edge of the bookshelf, that has potential energy, because if it tips over, it's going to fall to the ground, right? I think that's called kinetic energy. And then once it's on the ground, it doesn't have any more potential energy, because where's it going to go? So that book on the edge is like that Baptist preacher that he finally makes the plunge to invest, right? Those Vegas showgirls finally make the plunge to invest. When there's no more books left on the shelf to push off the edge, that's when you need to be afraid, okay? And we're really not in that kind of market right now. It's a little bit frothy, but there's still money on the sideline. There's still fear out there. The VIX is still kind of high. That's a gauge of fear. When the markets that are all-time high and the VIX that are at an all-time low, the most aggressive stocks are doing the best, everybody's invested and everybody's talking about investing, that's when you want to be afraid. And that's really not the case right now. There's a lot of pessimism and speculation. Pessimism and concern and there's consenting voices. Some people think it's a great market, some people think it's not. That's good. That's very healthy. When I started investing in Tesla, and people would say, oh, but I heard a lot of bad, this was like in 2019, 2020. I heard a lot of bad things about Tesla. And it's like, that's great, because that's like potential energy. There's like a lot of naysayers and a few people that see it, because that creates potential for it to go up, because as those naysayers start to get converted, they go into the market and they drive it up. When there's no naysayers left, when there's nobody that thinks it's a bad idea left, that's the market you need to be afraid of. So I really want you to see that dichotomy of the most risky market is the one that's absolutely done the best, that everybody's in, that nobody's afraid of, that they're confident. Like the guy said, what's the worst that can happen? Plus 25, right? When you're worried, that's good, because there's probably someone else worried. When you're not worried and no one else is either, that's when you got to be afraid. Okay, so what about wars? Well, isn't that kind of potentially bad? From an economic standpoint, right? Taking my morals and my ethics out of it, from just a pure economic numbers standpoint, I hate to say this, wars are good for the economy. Wars put people to work. Wars lower the labor force, which makes, unemployment numbers look better. War is not the thing that caused the Great Depression. War was the solution to the Great Depression. It's the thing that got the economy out of the Great Depression. So from an investor standpoint, war isn't the thing that we should be worried about. It's that euphoria. And like I say, we're not seeing it yet, but those are some of the signs that you should look for to really start to be worried. And we're not there yet. The VIX isn't at an all-time low. The market is flirting with an all-time high, so it's a little bit rich. The PE is a little bit rich, but these money-making companies are still doing better than. There's starting to be some interest in those money-losing companies, so that's a little bit concerning, but not like I've experienced before, not as in the precursor to these big market pullbacks. There's still some dissenters, there's still some money on the sidelines, there's still some things that make the market healthy. Difference of opinions are good. Okay, so I hope that gives you some clarity and direction on when you should call me and be worried, and when not to, and war isn't one of the times. Okay, so I hope you guys have a great week and a great weekend, and we'll be in touch. Have a great day.